Yes guys, you all are seeing it correctly, yet another episode of Chentology. What are we talking about? Well, it's still something that is rather basic but extremely used. It's the exponential moving averages, or the EMAs. A lot of people talk about it, a lot of people know it, but what does it actually do? And what actually is it? As you can see on the chart, there are a couple of lines. So the exponential moving average is a smooth price data to show the overall direction of the market, which means if it's above the line from short to long time frame, it's bullish. If it's below the line, it's bearish. Pretty simple, right? So it's a smoothed out price data into a line segment that either shows if we're bullish or if we're bearish. What makes it so powerful? Well, because it's the average, and because it's a good formula, and because it has been around for an exponentially long time, price always has the tendency to return back to the line. That by itself doesn't say much, I understand. Why doesn't it say much? Because it can be irrational longer than it is rational, and it can stay irrational longer than we stay liquid. But still, it's always a good rule of thumb to know if we're above the moving average, we're bullish, and below, we're bearish. Why are traders using exponential moving averages, or the EMAs? It helps them to identify trend, it helps them to find entry points, it helps them to find spots of reversals, and it also functions as a dynamic support and resistance. Why? Because if price goes against it from the downside, it might be resistance. If it bounces off of it, it might be support. So it's a pretty good factor of looking at where are we in the market, where are we going on every time frame. What are popular strategies to use with the moving averages? We have a couple of them. If price is above the 50 and the 200 moving average, price has the tendency to be bullish. So people are also looking at crossovers. A bullish crossover is the 20 and the 50, means a potential buy signal, and a bearish is also a crossover between the 20 and the 50. So if they cross over positively, it's bullish. If they cross over downwards, it's bearish. So what do the numbers in exponential moving average actually stand for? The 9, the 20, the 50, the 100, and the 200. It stands for the look back period in candles. So what does this mean? It means on the daily time frame, for example, that the blue line takes way longer to come down towards price. But if it gets tapped, the reaction of it will also be way higher. Why? Because the time it took to create or to get it there is significantly higher. So the lower the number in the moving average, the quicker and the higher the rate of adaptability, and the quicker it will reach the price again. Why is this important? Because the higher the number, the more likelihood of a reaction, and the more likelihood of it actually being the real trend. So if price breaks below the 200-day moving average, as you can see here, even though it was still creeping up to it, well, it's bearish. And the confirmation of it, even after a retest, is bearish. So moving averages, I would score them 7 out of 10. And I know most of my points have been around this region, but why is this again 7? I like them more than MACD because it's on the same chart and you can visually immediately see it. And it's good to determine overall bias. If you have any more questions or any more explanations needed, feel free to hit me up. And this was Chentology about the EMAs.